Hey, what's up, my friend? So, in this video, we'll talk about the stochastic indicator, right? First and foremost, right, I'll cover what is it and how does it work. I know some of you might be thinking, Rayner, the stochastic indicator is so simple, right? Below 20 is oversold, above 80 is overbought, right? But here's the thing. Let me ask you, do you know how the numbers on your stochastic indicator come about? Why is it sometimes 50? Why is it sometimes 60, 70, or 80? Right? I bet 90% of you watching this video now do not know why the numbers on your indicators move up and down. And so this is why I'm going to explain to you what is it and how does it work. Once we've nailed down the fundamentals of stochastic, right, then we can, learn how to apply it appropriately. The next thing we'll talk about is the biggest mistake, right, traders make with the stochastic indicator, right? Even I myself, I made this mistake in my early years of trading, right? So I'm going to share with you what it is and how to avoid it. Then I'll talk about how to use the stochastic indicator the correct way, right? I'll share with you how to use it to time pullback in a trend. I'll share with you how to use it to filter your trading setups so you can find better trading setups and as an entry trigger. Okay, so with that, right, let's begin. So what is stochastic? So stochastic, right, according to the founder, George Lane, he says that stochastics measure the momentum of price. If you visualize a rocket going up in the air, before it can turn down, it must slow down, right? So momentum always changes direction before price. So now the thing is, how does it, relate to what you see on your chart? So let me explain, right? So let's say there is this candle over here. It goes up higher, third candle bullish, fourth is bullish, and let's say the fifth candle is bearish, okay? Then I just, shade this a little bit. So let's say the high price over here is, let's say, $100. Okay, the low price, let's make it $50. And let's say it closed at, $90. So what will the stochastic value be? Right? If you understand this stochastic indicator, you will know how to calculate this value. But if you don't, right, then, that's why I'm going to explain to you right now. So it's actually very simple. What you're going to do is take the range, right, from the low to the close, right, from here to here, divided by the entire range from the highs to the lows. Right? So what's the range from 50 to 90? It's 40. Right? What's the range from this low to the highs? It's 50. Right? Why 40? You take 90 minus 50. That's why you get 40. Why 50? You take 100, which is the highs, minus the lows, which is 50. Right? You get 50. So what you get is 0.8. You multiply it by 100. You'll get 80. And this is what will appear on your stochastic indicator, a value of 80. Okay, so there you have it, right? If you have, come to this far, you probably know how stochastic numbers are derived, and you're ahead of, 90% of other traders who, use stochastic but don't understand, what it means. So with that said, what is the mistake that traders make? So you've learned earlier that stochastic is a measure of momentum. Okay, so a mistake that traders make is that they blindly trade overbought and oversold signals. So if you look at this, right, you can see that stochastic, right, often, right, you hear traders say, oh, look, stochastic is overbought, right, over here, right, price is above 80, stochastic is overbought, let's go short, right? If you go short here, you can see what happened, the market rallied. Oh, stochastic is overbought, let's go short, right? You can see that if you go short, the market continue to rally. So here's what it means, right? Let's interpret this, right, now as a trader who really know what stochastic means, right? So you can see this chart clearly, the market is in an uptrend, right? And earlier you read, right, and you learned that the definition of stochastic is a measurement of momentum. Okay, so essentially what you're doing when you go short when stochastic is overbought is that you are shorting against the trend against strong momentum. Right? Let that sink in for a while. Right? What you're essentially doing when you are shorting overbought areas in an uptrend is basically you're shorting against the trend against strong momentum. Okay, so now it's no surprise, right, why, if you do this, right, you're constantly, get stopped out over and over again. So this is a mistake that traders make, right? Do not blindly short just because stochastic tells you that it's overbought or oversold. Okay, so what should you do instead? Okay, so how do you use stochastic then? Right, so the first way you can use it is to help you time when the pullback will end, right, in a trend. So let me explain. So you can see over here, right? Clearly, this market is in a downtrend. Why is that? This is because, right? This is the 200 period moving average, right? My definition of a long-term trend is that if the price is below it, then the long-term trend is down. If the price is above it, right, then the long-term trend is up. Right? So earlier you've learned that you don't want to blindly, short just because it's overbought or long just because it's oversold. However, if you add a trend filter now, right, then things could make sense, right? So for example, this is a downtrend. Okay, so what if, right, stochastic can help you, time when the pullback will end in a downtrend. So for example, if the market is in a downtrend, then what we are looking for is for overbought areas on your stochastic indicator to serve to tell you where the pullback may potentially end. So if you look at it, right, if the market is in a downtrend, then you look for overbought areas. If the market is in an uptrend, then you look for oversold areas. So in this case, you can see that this trend is down and this is overbought areas on your stochastic, overbought and overbought. And this all pretty much coincide with, near to where the pullback will potentially end. Now, don't mistake me, right? I'm not saying go short just because the market is overbought. All I'm saying is that the overbought area in the downtrend is potentially where the pullback could end, right? If you want to, trade this type of setup, you would still, look for an entry trigger like, bearish reversal, candlestick pattern, and etc. All right. So this is just to serve as a purpose to alert to you to where the pullback may potentially end. Okay. So let's look at another example, right? This time around, this is in an uptrend, right? So again, in an uptrend, right, we want to look at oversold areas on your stochastic chart, which is this, right? Below 20 is oversold, oversold, and oversold. So it pretty much coincides with this one, and this one again. Again, right, it could alert to you where the pullback may potentially end in an uptrend. So moving on, right, another way you can use stochastic is to serve as a filter, right? I'm sure you heard the word filter before, right? A filter could serve as something to tell you whether you should be long or short. So how can you use the stochastic indicator to filter your trading setup? So what you can do is that, for example, this is the S&P daily time frame, and you notice that stochastic is oversold, right, in an uptrend. So this should tell you that, the market, or rather the pullback, could potentially end. So if you are, let's say you are trading off the lower time frame, right, and you see something like this, right, this green line you see over here, right, is pretty much the same green line you see over here on the 1 hour time frame, right? This should alert to you that, you don't necessarily want to go short too aggressively because the higher time frame, right, stochastic is oversold, right? So maybe you may want to choose to not take any short trades altogether, or maybe if you want to short, right, you're going to be quick in taking profits because the market is possibly near the end of a pullback on the higher time frame. So this is how you can, use stochastic as a filter for your trading setup. And lastly, right, you can also use stochastic as an entry trigger. So what is an entry trigger? Entry trigger serves as a confirmation, right, as a entry timing tool, right, to enter the trade. Common entry trigger could be, a bullish hammer, candlestick patterns, and etc. So stochastic can also serve as an entry trigger. So how do you do it, right? Is that when the market trades above the oversold levels or below the overbought levels, that could serve as an entry trigger. So you can see over here, the stochastic has, clearly risen above the oversold level, right? So this could be an entry trigger to go long, right? Same for this, entry trigger to go long, same for this and this, right? Don't mistake me, right? And one more over here. Don't mistake me that, hey, just go long when the oversold, the stochastic rise from oversold levels. That's not what I mean, right? What I'm saying is that it could serve as an entry trigger if you have already a bias to go long. You have other, confirmation, other, confluence factors that tell you that the market is about to trade higher. Then, hey, this could be a entry trigger, right? A tool to tell you to enter the market right now, right? So this is how you use a stochastic as an entry trigger, right? If it rise above the 20 level, right, you can look for long setups, and if it falls from the 80 level, you can look for short setups, right? So this is how you use it, right, as an entry trigger. So now some of you might wonder, hey Rayner, why does your stochastic only have one line, right? Mine has 2 lines, right? Why is that? Simply put, right, because this is the settings of my stochastic indicator. The K is 20, right? It looks past the last 20 candles. The D is 1. The D is simply the moving average of this line you see over here. So if you put in 5, right, it will be a 5-period moving average of this line that you see on this chart. And to me, right, there's no point having 2 lines on the chart. I can't see the purpose of it. So I removed the second line by just changing it to 1, right? And this is why I only have 1 line on my stochastic indicator. Okay, so let's do a quick recap to what you've learned today, right? Number 1, don't blindly, trade, overbought and oversold signals, right? As I've mentioned, right? You want to understand what stochastic mean, right? It's actually a measure of momentum, right? If you just blindly trade it, you can actually be trading against the trend, trading against the momentum. So be careful with it. Next, right, I shared with you, you can actually use stochastic to help you time when a pullback will end. It can help you filter your trading setups, whether you should be long or short, and to serve as an entry trigger. Okay, so before I end, right, go down to my website, tradingwithrayner.com, right? This is where you can actually learn more about the works that I do, right? So, for example, right, I recommend you downloading the Ultimate Trend Following Guide. This will teach you how to actually write massive trends, right, in bull and bear markets, right? Just click this blue button, right, and I'll send it to your email. The other guide I suggest you also get your hands on, right, is the Ultimate Guide to Price Action Trading, right? Basically, you'll learn how to read the price action of the market so you can better time your entries and exits. Again, this blue button, enter it, and I'll send it to your email. And both guides are completely free of charge. Alright, so with that said, I have come to the end of this video. If you have any feedback, comment, just let me know below. And if you like this video, right, please hit the subscribe button, hit the like button, right, because it will really make my day. So with that said, I'll talk to you soon.